Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua, live from Davos. Now, it is a blockbuster show today. Out from the World Economic Forum, we'll be joined by three big guests. In 10 minutes, Manus Crani interviews the OPEC Secretary General. Then at half past the hour, we'll also speak to the German Economy Minister, Robert Habeck, followed by the Credit Suisse Chair, Axel Lehmann. But first thing is first, let's check in on the markets with our Danny Berger. Hi, Danny, what do you have?
Hi, Francine. Well, I gotta say, some of the conversations you've been having, Philip Hildebrand comes to mind, warning that this market is too optimistic about a lack of rate hikes or cuts, seems to be filtering through. We are looking at European stocks moving lower today, consolidating after reaching the highest level since April yesterday. One of the things that has been helping European stocks, though it's not today, is nat gas continues to move lower. It has lost about 20% in about 3 days, trading at its lowest since 2021, thanks to increased stockpiles in Europe. Finally, you are looking at rate bet hikes, changing those bets around the UK after wages came in for the region at a near record pace. That means we're seeing the currency, sterling, that's stronger against the dollar, up by about 0.2%. And we're looking at bond sell-off gilts. Those yields are higher by about 3 basis points. And that matches some of the action we're seeing both in the rest of Europe for sovereign bonds and U.S. Treasuries, where 10-year yields are higher by about 4.5 basis points, Francine.
Danny, thank you so much. Now, the UBS chief executive, Rolf Hammers, believes inflation will stay higher for longer. Well, he spoke to Manus Crani earlier here in Davos and explained why the Swiss lender aims to boost its U.S. business while also keeping a long view on China.
Just go back last year, the war, the sanctions, the energy crisis, supply chain still faltering. I do think that the opening up of China, the impulse it gives to consumption in China, energy need, commodity need in China as well, I do think it's a very good signal. It will be supportive of a momentum, but the true inflection point we have not kind of seen yet.
The natural corollary to that is you as a house were way ahead on your call on China. You've reaffirmed it this morning. Is that movement from China, has that been reflected by the clients? Are they much more active in taking China risk?
Well, we've seen more activities, but we have certainly advised them to go long on China and to be overweight on China. That's what we came out with on time, I guess. I think we were all a bit surprised as to the speed at which China opened up, but I think. Advising the clients, and they really have come, and you know that from the third quarter, clients in periods like this need more and more advice. They really come to me, I'm talking to them, and they're saying, well, okay, help me reading these data, help me reading these trends, where should we go? And basically they put a lot of money with us to manage for them, right, in the third quarter.
And are you saying cash first, reflect and wait for a pivot? Or are you saying actively deploy, but judiciously? Which is the narrative for you?
We're still cautious as to the balance that you bring, and but there is moments to invest. There is absolutely moments to invest.
The other big debate is this: peak inflation, peak rates, and peak liquidity. Now, there's two bids there, and there's one offer. Yeah. If I look at the inflation narrative, the consensus is building peak inflation, and it will drop precipitously. Are you expecting a precipitous drop in inflation?
We are expecting that every month we will see a further decrease. I think that inflation at higher rates than what we're used to is here to stay. And there's a reason for that. If we truly look at what has happened to us in the world over the last 3 years, we do think that we're going into the era of security. It's energy security, it is about food security, it's about technology security. For that, part of the supply chains that we are still dependent on will have to be rolled back, which basically means you bring labor back, you have to invest. The energy transition is still at its infancy, at its start. Lots of investments will have to go into becoming less dependent on energy from other countries. So I do think that inflation will be higher than what we are used to in the past. So it will not come down to the 2% that we are used to. So we'll have to work with that, but it will decrease from here.
Well, that was the UBS Chief Executive Officer, Ralph Hammers. Now, stay with us for a big day of interviews at the World Economic Forum in Davos. Amongst our other guests today, we'll also be hearing from Ferdinand Marcos Jr., the President of the Philippines, plus the OPEC Secretary General, Haitham Al-Ghais. Now, don't miss our exclusive interview with the German Chancellor, Olaf Scholz. Bloomberg's Editor-in-Chief, John Micklethwaite, will bring us that interview live, so stay tuned for that. Now, let's also get to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. The World Economic Forum's annual meeting is underway in Davos, with corporate executives and economists warning a global recession is likely this year. A PwC survey of business leaders late last year found 73% thought global growth would decline over the coming year. That's the highest proportion since polling did begin back in 2011. Eurogroup Chief Pascal Donoghue has told Bloomberg the euro area is in a very resilient place and is likely to avert a recession, albeit with a very low level of growth this year. EU Economy Commissioner Paolo Gentiloni, meanwhile, says inflation is past its peak.
I think we managed to reduce energy dependence. Energy prices went down significantly, and inflation peaked at the end of last year in Europe. So there is a chance to avoid a deep recession and maybe to enter a more limited, shallow contraction.
Now, China's economy grew at the second slowest pace since the 1970s last year, but fourth quarter data was better than economists had actually expected. GDP growth slowed to 3% in 2022 as the country doubled down on its now abandoned COVID-0 policy. Growth slumped from 8.4%, and that was in the previous year. Now, U.S. Treasury Secretary Janet Yellen will hold her first face-to-face meeting with Chinese Vice President Liu He in Zurich. That's happening tomorrow. Beijing says the talks are aimed at strengthening economic and also financial policy coordination. The announcement follows a November meeting between Presidents Joe Biden and Xi Jinping on the sidelines of the G20 in Bali. The UK government has blocked transgender rights legislation passed by the Scottish Parliament, setting up a major constitutional row. Westminster says the law would have an adverse impact on UK-wide equalities legislation. It's the first time the UK has actually blocked any legislation passed by the Scottish Parliament since it was formed back in 1999. China's population fell last year for the first time since 1961. According to official stats, there were 1.4 billion people at the end of last year, 850,000 fewer than a year previously. A drop in the number of births to its lowest level since 1950 was the biggest contributor to the overall change. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. We're just getting also some breaking news from that German defense minister story. Yesterday, we saw that, of course, there was a resignation. Now, Boris Pistorius will be named German defense minister. Of course, this is according to the Spiegel. We need full confirmation from the government, but it will certainly put Germany at a better footing as they deal into negotiations on a number of factors with Ukraine. It's always very difficult to be taken seriously and to be able to negotiate thoroughly if you're lacking the proper minister. So we now have that hole filled. Coming up, we speak with the OPEC Secretary General, Haitham Al-Ghais, live from Davos. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. Good morning to our viewers and listeners of radio worldwide. I'm Francine Lacqua here in Davos. Now, we're back here in Davos where the world elite are gathering for the World Economic Forum's annual meeting, the first one in 3 years where we're in the snow. Let's get out to Manus Krani, who's there talking oil with the very special guest. Manus.
Francine, thank you very much. A very good day to you. Joining me here on the rooftop, it is Secretary General for OPEC, Haytham Al-Gaith. It's my first Davos. I think it's yours as well, officially for WEF. So we can both put our stamp on this. Everybody's debating the world economy. From the data you look at, are we flashing amber, red, or is there a hint of green in the global economy?
First of all, Manus, thank you for hosting me. Indeed, it's my first Davos, and delighted to be with you first in Bloomberg TV. Wishing you a happy new year. We came into this year, as you recall, back in the fourth quarter with growing signs of recession, global slowdown in economic growth, signs of China closing down. Nobody knew what that would look like, what it would lead to. I think now we're still too early into the new year to determine exactly if it's going to be amber, green, or red. But we're seeing signs of green. I must say, however, we are always cautiously optimistic. We have been I have personally said this to you before in our previous interviews, we've been always very bullish on China.
Yep.
China is a big economic powerhouse, has significant implications for global oil demand. And we saw what happened when China closed down. Now everybody is optimistic about China opening up. So I say, yes, we are optimistic, but again, we are cautiously optimistic. We have to see what happens when the Lunar New Year takes place in a few days, what that means. The travel now is booming domestically, but also China travel could boom internationally.
There is a tail risk that after the Lunar New Year, we get another spike in COVID, which could unseat all of our optimism. But run me through your fully more optimistic, full throttle China, full reopen. What will it mean for demand for oil?
Well, we're going to issue our new monthly report, the first report of this year, 2023. We see demand rising in China. We've been, again, even with all the slowdown we were forecasting before, we have seen Chinese demand predicting that it's going to grow by around approximately 500,000 barrels a day this year. And we're seeing different views, different numbers, but again, it's a bit too early to say exactly what will happen. We're seeing also signs and news about bigger Chinese crude import quotas being given by the government, which is a good signal that China's buying is going to pick up again as we get through the first quarter.
So moderate cautious, Secretary General, is my first take from those couple of answers. You're preemptive, you're proactive. That is the byline of OPEC+. So the case, as we go to the JMMC in February, from this caution that you're giving me, is the case building for a deeper cut?
Well, again, it's very premature to say we have to meet and review everything. We're only into the second week, basically just starting into the third week of this year. A lot of moving factors, moving elements. We can't really jump to a conclusion from now and say what we will come up with. The JMMC, however, has a clear mandate to observe, to monitor, and to be quick and vigilant in calling the ministers for whatever is necessary. Whenever we require to call for a ministerial conference, we are watching so many moving parts at the same time, China just being one of them.
And I think it's good that you pull me back from that over-bullish position. The first 2 weeks of the year, we need to reflect on the data. But let's project forward. You've got 500,000 barrels a day for China. Let's say things go well, things open up full Monty. Do you see, because we talked about this, do you see a deficit in the oil market in the second half of the year in that scenario?
Well, there's a balance we have to look at as well in the market. We can't just isolate China from the rest of what we see in the oil markets. I mean, we're talking about a slowdown in Europe. We're talking about a slowdown in the US potentially. Still, there's the element of inflation that's being combated and targeted by central banks around the world, especially in the West. So we have a tale also of two different markets. One potentially where the advanced economies could continue to slow down.
Do you think full recession for the advanced economies?
Slow down into potentially recession. Some people already saying we are in parts of the world in recession, in Europe, for example. And the other part of the market we see is China and potentially Asia, Middle East, India, all picking up. So we have to balance the two, and we cannot really come to a clear conclusion as of yet. I think by February, March, after Lunar New Year is over, after we push through a couple of months into the new year, things will become more evident and more clear.
What could cause OPEC Plus to unwind the 2 million barrel a day cut? When I came to Vienna, it was announced. We were all summoned, and you had the big headline. What could cause OPEC Plus to step back from that 2 million barrel a day cut?
We are always looking at everything in the market, Manas, and we've said this repeatedly. There's many fluid factors moving along at the same time.
Okay.
There is demand, there's supply, there's a potential risk of recession. Whatever it takes to manage the market and keep it stable, we will do. But we have to not preempt and not be overly judgmental at this stage of what may happen.
The other side of this trade is the plus. Russia, the dominant supplier. Novak has made it clear that he's prepared to slash production by 500 to 700,000. He says that that is insignificant. Is that insignificant if Russia, they haven't done it yet, 500 to 700,000 barrels a day, is that insignificant?
Well, nothing is insignificant in my perspective. I mean, 500,000 barrels a day is big. Russia is a big producer. They produce over 10 million barrels a day, one of the biggest producers in the world. But again, this is only part of the equation. We have to look at it holistically.
How would OPEC Plus react to a material loss like that?
Again, it's premature. I think we would have to really see it. I can't really predict what would happen, but we have to look at the overall global balance. It's not just Russia. We have U.S. production rising. We have production rising from Brazil, Canada, Guyana. OPEC Plus, we have now spare capacity thanks to our decision we took back in October. So there are a lot of moving elements, and you couple that with what's happening and the demand side risks we are talking about. There's a lot to look at.
We're here in the cold and the ice. You talked about a thin buffer and balance of spare capacity. I presume it's getting thinner. How thin is the spare capacity now? Are we breaking spare capacity?
Well, actually, to the contrary. I mean, after our OPEC, after the October decision where we agreed to adjust production downward, we now have more spare capacity. And this is something that the market was worried about all the time. But I also want to take this around to the issue of investment. I mean, when we talk about spare capacity, again, we've cautioned and we've repeatedly called for more investments in order to have that spare capacity that everybody is concerned about. We in OPEC are doing our part. It's a holistic view again. It's not just in the upstream. I mean, we talk about the medium to long-term outlook. We're talking till 2045. The oil industry alone needs $12.1 trillion of investments. This is significant. We're already falling behind. We've said this before. We need today to invest just to keep production at current levels, let alone cater for additional demand, which we see rising by at least 10 million barrels a day by 2045.
Well, let's hope the banks have the thirst to lend appropriately on fossil fuels and beyond. Secretary General, great to have you with me this morning.
Thank you, Alice.
And good to break a bit of ice together on Davos. Francine Lacqua, good morning.
There you go, your first Davos, and you're already moving markets. Manus, great interview with the OPEC Secretary General, of course, on the latest with the oil outlook, with also price range that we could be looking at. Now, Marsh McLennan is one of the world's largest consulting firms and insurance brokers operating in more than 130 countries. So with us now is John Doyle. He's the Chief Executive Officer of Marsh McLennan. Thank you so much for joining us.
It's great to be
John,
with you,
there's
Francine.
so much to talk about. First of all, are you more or less optimistic about 2023 than you were of 2022?
I'm excited about 2023. There's a lot in front of us for our business. We're, it's 85,000 people strong, advising clients and governments around risk strategy and people. And there are a lot of issues to confront. We just published, of course, the Global Risk Report in conjunction with the World Economic Forum. And there's a lot to confront. And so it's a big opportunity for us as a business.
And if you survey chief executives, they're worried about the future. It's not necessarily a recession, but certainly a big slowdown. What will that look like? What are the winners? Who are the winners of this recession?
Well, it's complicated, of course. There'll be lots of winners and losers in this kind of market. But they're worried about inflation. They're worried about energy supply. Of course, they're worried about extreme weather events, geopolitical uncertainty. So there's a lot to confront, and we're helping businesses and governments confront those issues all around the world.
What's the question that you get most often from chief executives?
Oh, I think the economy. Everyone's worried about the risks of a recession, and not just a mild recession, but a hard landing, later in the year. And things look okay right now, but it's quite obvious that central banks' top priority is tamping down inflation inflation, and that's going to have an impact.
So, John, do you worry actually that we haven't seen more companies go under and that it will all come at the forefront? I mean, it's pretty incredible to go from 0 interest rates to 3, in certain cases 4%, without damage to businesses.
Yeah, you know, look, I think we've learned a lot from events over the course of the last couple of decades. So banks, of course, are far more resilient than they were in the past. So there are credit risks in front of us for sure. But but I think we'll be able to navigate it reasonably well. So I expect an impact to the economy for sure, but maybe even a mild recession likely. But I think we'll be able to navigate it okay.
So navigate how? Again, who will win the most? If you look at the sectors and industries that you advise.
Well, we're helping clients become more resilient. And, it's not just the current economic conditions, but learning from the great financial crisis, learning, of course, from all the issues that we confronted in the pandemic. Businesses and governments are trying to better balance resilience as opposed to finding great efficiency.
Where do you see the most efficiency? So we're seeing a number of sectors, cost cutting, margin earnings were actually okay last year.
Yeah.
What's it looking like in 2023?
Yeah, and it's early, of course, in the fourth quarter earnings seasons, but I suspect in most major markets earnings will be okay.
John, overall, what is the one we look at some of the pitfalls and some also of the bond issuance? There's something that really caught our eye, which is the first cyber catastrophe bond sold in London last week. What does that tell us about the future?
Well, the risks of a digital economy are certainly very much on the mind of business and government leaders all over. And certainly the war in Ukraine created some even greater awareness of all these risks. And so that's an important development in the insurance markets and one we're incredibly supportive of. We need to bring more investors to the game to really deal with tail risks in cyber.
John, thank you so much for joining us today. That was John Doyle, Chief Executive Officer of Marsh McLennan. We'll get you a warm drink because it's so cold out here. Danny, what are the markets looking like today?
Francine, it continues to be a down session for this equity market. Of course, I feel guilty because I'm telling you this from a very cozy, warm studio. But yes, European stocks down about 1/3%. Nearly every single industry in the Europe Stock 600 is down lower this morning, save for energy and ever so slightly basic resources. This comes off the back of a Goldman Sachs call for a bullish concoction for the commodity market this year, given China reopening, given that tight supply. However, one commodity that Goldman points out that tight supply isn't necessarily holding true is for nat gas. Nat gas prices, those continue to drop another 5% this morning. It's been really remarkable to watch in the past 3 days for nat gas. Those are Dutch front-month futures there, dropping 20%. Now, it's not just that Europe has done a good job curbing demand, especially given the weather is more mild, although, of course, it is turning cold now. It really has to do with supply. We've seen a lot of the LNG supply from Asia, from China, get rerouted into Europe. So those higher stockpiles mean that prices have been able to fall to their lowest since September 2021. Now, does that change when China comes back online, when the demand starts to grow? Only time will tell there. Meanwhile, UK assets seem to be preparing for more of a rate hike after hot UK wages. Francine.
Thank you so much, Danny. So we look at the markets. Really, the conversation here is also on rebuilding Ukraine at the forefront of all geopolitical tensions. One of the panels that I'm most looking forward to is, of course, understanding the way forward for this country, some of the support also that's given by the West, and how much this will cost and also how much this will last. So I'm delighted now to be joined by Yulia Sigarenko. She's Ukraine's economy minister. Minister, thank you for joining us.
Thank you.
It's really a great honor to understand through your eyes what the economy is going through. Of course, we always think of the loss of life and everything that your country is going through, but how much in terms of economic support do you need to start to rebuild the country? Is it too soon to talk about that?
Okay, so actually the fall of Ukrainian economy in the last year was about 30.2%. So actually our prediction were even worse at the beginning of the war. So we estimated that it might be up to 50% of GDP lost by the end of the year. But it's 30.2, and we hope that this year is going to be the year of the early recovery, and it would be the year of the small growth of Ukrainian economy. Of course, you understand perfectly well that everything depends on the military situation,
of course,
and on military scenario.
Yes.
That's why even in Davos in during the economic forum, we will be focused in our discussion on military support, first of all, and on a peace formula that was launched by President Zelensky during the G20 meeting. So,
but, Minister, there's, of course, a legitimate reason to ask for money or cash, for example, for the farmers that are slow, that need to continue doing the crops. So what kind of support are you getting on that level? And the more the missiles strike, the less you have infrastructure, and so, of course, the more money you need.
Yes, so if we speak about the covering of the budget deficit, so we need $37 billion US, and we understand that this money will go from EU support, and we are very grateful, and from of course, United States, and we hope that we are going to be the part of the full-fledged program of International Monetary Fund.
Right.
So it's about covering the budget deficit. And of course, a big attention, it's running Ukrainian business, how to run Ukrainian business, how to make Ukrainian business operate. So that's why we would like to focus on providing the insurance from our partner side to set up business and restoring. And of course, you're absolutely right. During the missiles attacks on energy grid, now we essentially need generator, transformator, everything that makes our system works.
But Minister, so, and I understand maybe this comes second, but some of the risk insurance instruments, when do you think they'll be available for businesses?
So MIGA and DFC, MIGA is a part of the World Bank, and DFC are already ready to provide us with the insurance program for a foreign business and Ukrainian business that would like to set a business or to participate in recovery during this early stage during this early stage of recovery. I mean, during the wartime. So they are able to cover 90%, and now we are just discussing about the interest rate. But I think that we will be able by the end of this month to finalize the product for our partners. So we will be able to provide this, let's say, like financial ecosystem that will give the understanding where exactly foreign companies should go to take this insurance, so to ensure themselves to start the reconstruction. Because for us, it's essential not to wait until the war will be finished and to start now, because we need to find a way how to return Ukrainians back to Ukraine. Because it's our muscles, it's our brains, and we need them we need them back, and they want to return back. So that's why, together with partners here, we would like to work out tools for Ukrainian business and for foreign business, as we understand that foreign investment is going to be the core of reconstruction. That's why we need to find a solution how to facilitate them to enter the Ukrainian market even now.
Minister, thank you so much for giving a little bit of your incredible busy schedule to Bloomberg. That was Ukraine's Economy Minister, Yulia Shiradenko. Now, South Africa's president has cancelled his trip to the World Economic Forum this year for emergency talks with state power utility Eskom, as the nation's rolling blackouts threaten to further weigh on economic activity. But the nation's finance minister told me about the company's balance sheet and just how much Eskom debt that the government can take on.
Eskom should be able to find ways of raising money to pay for diesel. So that's not, in my view, a major problem. So I've outlined 4 things that need to be done as a matter of urgency. One of the key points is not only to focus on diesel, is to focus on the 48,000 megawatt capacity which Eskom has, which unfortunately is coal-related, is to bring that power back.
Minister, how much of the debt will you assume?
We said in the medium-term budget policy statement in October that there are a lot of variables which will influence how much of that debt we're going to take over, one of which was the pronouncement by NERSA. We wanted to know how much are they going to give increase to Eskom, which will influence Eskom's cash flow moving forward. That has happened, and now we're working on the figure we'll be announcing on the 22nd of February.
2/3?
I said between 1/3 and 2/3 then. But now we're working on the exact figure, which we'll announce next month on the 22nd of February.
But can you give us an indication? Would it be below 2/3?
No.
Give me a price range.
No, I said,
a range that's wide enough not to get you in trouble, but for investors to understand.
Between 1 and 2/3. I'm beginning to narrow the range because of just this last week getting Eskom's and NERSA's increase, which will begin to help me to narrow the range. I can't narrow it at the moment.
Is it narrowed at the high end? Is it narrowed at the high end or the
Wait
top
for
range?
that on the 22nd of February next month.
But Minister, so after you announce it, how quickly can you then deal with it?
Even those modalities will be part of that announcement.
Can you tell me if it's brief or whether we need to wait much longer? Again, broadly, what kind of timeline? Is it 2 months? Can it take longer? How fast?
I've got to take a number of factors into account. How much does it, what implications would it do on the debt to GDP ratio and so on? How do I stabilize that debt ratio over the longer term? Those are the factors I've got to take into account.
South Africa Finance Minister Enoch Godongwana there speaking to us in Davos. Now, we continue, of course, our World Economic Forum coverage here in Switzerland. Joining us now, Axel Lehmann, the chairman of Credit Suisse. Thank you for joining us. It's a great pleasure to speak to you. We're just on a panel together looking at the possibility of a recession and, of course, all the pitfalls. You mentioned geopolitics and some of the tensions there. Do you think Europe will be on a better footing in 2023 than it was last year?
I hope so. I hope so. Yes, I believe so. On Europe, on the positive side, what you see, I mean, it's amazing. The whole energy supply from Russia is basically breaking up, falling away. But Europe seems to cope with it. Yeah. Yes, but Europe will be a hard time. Energy cost for Europe will be the highest globally for many years to come, and that is a competitive issue for the European industry.
What does that mean for your client base? So I know you've had issues with outflows. Is it easier now? Have you been able to, tell clients to come back?
Yeah, it's interesting to see. People are really watching carefully. Inflation is the topic of Davos, the topic of the day. But when you peel back the onion, a multipolar world is coming with the East partially decoupling slightly from the West. We have China, India, US, Middle East, huge growth opportunities. So people try to redirect their investments. There's plenty of money, plenty of resources, plenty of appetite, and they are looking to drive innovation and find the next wave.
How are your client inflows going? So are we in a better place? We spoke in London, and again, it felt like a turning point for the bank.
Yes.
Where are we now?
Obviously, we had that social media storm. I don't want to go back to that. Horrible, the outflows. It has basically stopped, dribbling out. It's slightly coming back. So that is very positive to see, and I'm rather, optimistic for the remainder of the year. It's still early days, so it depends all where the global economy is going. But the clients standing by, they want to do business, they want to invest.
What are bonuses looking like for your employees?
Well, we will communicate that, in due time. Obviously, we had such a poor year. There was a horrifying year for Credit Suisse. So I think people have realistic expectations that it will not look great.
I mean, will there be also compensation, related issues for the board? Are there cuts coming or things like that?
We look into very, very carefully. On one hand, you have that topic of retention, and then look, we have plenty of parts of the group that is doing extremely well. So you need to compensate somewhat fairly, but you obviously need to look also at the shareholder perspective. You suffer huge losses. That is clear that the budget get cut also on bonuses.
So the board compensation is on the table. It's something that you're, I imagine, looking at as well.
We look to everything from executive board, employee compensation, of course.
Talk to me a little bit about Credit Suisse First Boston. Where are we on that?
Well, I know this is an idea, strategy that creates a lot of excitement. We will obviously get much more into detail. I would expect around, the fourth quarter results release on beginning of February. But we will execute on the plan. We said it's, to put it partially in a separate unit. It will be more a partnership-led model. We are looking, and we have a great interest for third-party investors that would like to join. Yeah. We will reshape our leverage finance business. So there are lots of elements. Yeah. We bring it all together, and then we will inform the market.
Okay, so you're confident that you'll get an anchor investor. You're close to finding an anchor investor.
I'm really confident. I'm confident in the plans. I see also confidence when I see the speed of execution. We are putting now various puzzle stones together, and we'll then have a first communication in a more comprehensive way to the market.
Okay, Axel Lehmann, thank you so much for joining us. I can't believe you're not wearing a coat. This is like the difference of when you're Nordic and when you're Mediterranean, because I'm freezing. But you're fine. Axel Lehmann, the chairman of Credit Suisse there. Now, coming up, we'll have plenty more from Davos, from the World Economic Forum. Don't miss our interview also with Saudi Arabia's finance minister, Mohammed El Jadaan. That's next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in Davos. Now, we're live, of course, at the World Economic Forum 2023. The global elite are back for the first time in 3 years, and with some great interviews. Also, Isman is speaking with the Saudi finance minister. Manis, over to you.
Francine, thank you very much. Very good morning. Mr. Al-Jadaan joins me, Minister for Finance for Saudi Arabia. Welcome to Davos. Welcome to Bloomberg.
Thank you.
Let's start global. I mean, you provide the oil to the engine of the world, to China. The reopening is accelerating faster, I think, than anybody ever presumed. What are the ramifications for the world and for Saudi?
Thank you very much for having me first, and it's good to be in Davos again. I think the world is going through a lot of issues, and energy security is one, geopolitical tensions, inflation, a lot of things that will need really to be attended to, and Davos is one way of really having a dialogue. China is reopening. It is not a surprise. I think they had their zero COVID policy for some time, and now they realize that they need to open, which is good. I think it's good for the world economy to have China. It is good for the supply chain to have China back in action. On the energy side, what we are trying to do is trying to invest as much as we can, both in the conventional energy but on renewable energy, to make sure that the world is supplied with enough energy.
Does their reopening put a floor under the global economy?
I think it helps definitely to support the world economy. The world economy needs that support, and a lot of countries around the world are facing recession, so we need some support.
Where are you most worried about in terms of recession? Because the blowback takes a bit of a time to land on your shoulders in Saudi and mine in the Emirates. Where are you most worried about globally?
I'm worried really about the most vulnerable nations, most vulnerable countries, low-income countries. Their debt vulnerabilities is really, really serious. We are seeing defaults, and we are likely to see even more defaults. And we need to work with multilateral institutions to make sure that we find solutions. And Saudi, during the G20 presidency, put forward the DSSSI and the common framework to help try restructure the low-income countries' debt.
Debt vulnerability and defaults, I mean, those are big words. Do we face a global risk of a major default this year, do you think?
I think there will be serious risks in certain countries. It is not about really the spillover of the debt itself, but what it means. It means a lot of issues for the people in these countries, a lot of difficulties. They will not be able to deal with inflation. I mean, more than 10 countries are now paying more than 10% on their debt. How are they going to afford it?
And that is where the sustainability comes in. But with that comes regional policy with Pakistan, with Turkey, with Egypt. I want to drill into Pakistan. A huge outreach, I would say, to deliver stability to some of those vulnerable countries that are at risk on the debt side. Where are we with Pakistan in terms of delivering more funds to the central bank to shore it up? You've put in 3. Will you raise that?
I think if you talk about the region, you need to talk wider than Pakistan. I think there is Pakistan, there is other countries in the region that will need support. And Saudi Arabia have been in the first place to provide that support to the region. It is very important to bring stability. It's important to bring really more focus and even in reform and economic reform that will help these nations. We are working with multilateral institutions, with regional institutions to provide that support. Pakistan, Turkey, Egypt. I mean, we are providing a lot of support to Egypt, and will continue to, not directly through just grants and deposits, but also through investments. We are investing heavily in these countries, and will continue to look for opportunities to invest.
And are we right to say it is a $10 billion? I want to finish with Pakistan. Is the ambition to get to $5 billion in the central bank and $10 billion into the economy? Is that my takeaway? I
think the ambition is very clear. His Royal Highness, the Prime Minister, made it very clear last week that we are looking to invest $10 billion in Pakistan. We have a deposit that we have just signed an extension for. We are providing even oil and derivatives to support their energy needs. So there is a lot of efforts, but we wanted this to be collective. We are working with multilateral institutions, including the World Bank, to see how can we be more creative to provide that support.
Let's just pivot quickly back to China, because Xi visited Saudi Arabia. Red carpet was rolled out. Was there a discussion around paying for oil in yuan. Fill or kill on this rumor?
Okay. Two things. One is we enjoy a very strategic relationship with China, and we enjoy that same strategic relationship with other nations, including the US, and we wanted to develop that with Europe and other countries who are willing and able to work with us to advance the public good in the world.
Yes.
I think with regard to China, they are the largest trading partner with Saudi Arabia. I think there are no issues with discussing how we settle our trade arrangements, whether it is the US dollar, whether it is the euro, whether it is the Saudi riyal or their currency.
There was no discussion on that at all.
I don't think we are waving away or ruling out any discussion that will help improve the trade around the world.
Let's close with this. Saudi first, it's made very clear by His Royal Highness Prince Abdulaziz bin Salman in his rhetoric. Saudi first, does that push you more towards China for your financial ties and relationships than it does to the US? Is a pivot in the making, and will it evolve more quickly than we think?
I don't think so at all. Actually, we are working with both. We have a lot of interest in our relationship with the US. Our rial is pegged to the US dollar. A lot of our economy is traded through US dollar with international partners. But we also look for China and advancing the relationship with China. We trade with them significantly. They are the largest trade partner with us. So we wanted to make sure that we bridge this global divide and provide ways to ensure that this fragmentation is contained and cooperation and collaboration is improved.
Minister Al-Judaan, I wish we had more time. We could explore the regional policy a little bit more, but from a global perspective. Thank you so much for joining us here on Davos this morning. Francine.
Thank you so much, Manas. Now, we'll have plenty more, of course, throughout the day. That was Manas Karani and Mohammed Al-Judaan of Saudi Arabia. Now, let's also talk about other economies. We're now joined by Germany's Vice Chancellor and Minister for Economic Affairs and Climate Action. He's Robert Habeck. Minister Habeck, thank you for joining us. I mean, there's a lot going on, especially in Germany at the moment. Yesterday, we broke the news that your defense minister had resigned. Now, according to Bloomberg sources, Mr. Pistorius will be the new defense minister. Do you welcome that?
Well, it's not officially said, but it could well be, and yes, I welcome it. I know Boris Pistorius well from former jobs I had. He's a very experienced politician, very strong nerves. I think he's the right representative for the German army, and he will also be a man able to take strong decisions in short time, and this is what is needed.
And this is needed because, of course, of the war in Ukraine,
Absolutely.
decisions on tanks and things like that. What kind of new phase does that mean for Germany? Is there going to be more support for Ukraine, you think?
Well, we have given more and more and more support. So you see there is a dynamic from the German starting point before the war that we won't deliver weapons in zones of conflicts. We are now delivering all sorts of weapons, actually not all sorts of weapons, the heavy tanks we don't, but we always said that we will adjust our decisions in the line of the argument of our partners. This is mainly the US, but also the other partners, and you see Great Britain, Finland, Poland, they are willing now to bring tanks to Ukraine. First question is Germany, there are German tanks, or Great Britain not, but the Finnish and the Polish tanks, German tanks, we have to say yes to that. I argue that we will do that.
Yeah.
And,
this is for the Leopard battle tanks. Would you be in support in sending those?
Well, we haven't made a decision. If Germany gives own Leopard battle tanks to Ukraine, we will do this in line with the alliance. So if America would decide that they will bring battle tanks to Ukraine, that will make it easier for Germany. You know our history, and we are a little bit more reluctant there for understandable reasons. But
why reluctant? I mean, the reluctance also really came from the
because of our history
Chancellor.
bringing tanks and tanks fighting against Russia. But this is not my perspective. I think we adjusted our position many times over the last year, as every country has done, and Ukraine has proven that they are careful on the battlefield but successful. They need more weapons, and Putin is not seeing that he's making a big mistake. He's offering his population now, the men he's sending to the front, they are just they're doomed to die, a lot of them, but still the war's ongoing and Ukraine needs more support, and this will be one of the first decisions the new Minister of Defense has to take.
Is there, Minister, a red line? I mean, we're also talking about possibly sending fighter jets. At some point, does this get taken as a declaration of war from Putin? Does he interpret it as actually we're now full-on war?
Well, the red line must be always that we are not engaged in a third world war, that the war increases that much, that the US, that Europe, that Germany will be will be part of the conflict, meaning that we can't stop it anymore. So it must stay at the front, at the battlefield, Ukraine. But saying that means also that Ukraine must succeed. They have to win the war, and we have to give them all the military equipment that is needed to win the war. And now we are discussing the tank question.
Minister, talk to me about the economy. Are you surprised at how resilient the German economy has been? Despite the war, there was growth of 1.9% last year. Is this thanks to the mild winter, and do you think we'll avoid a recession?
We had 3 mild weeks, but before we had 3 tough weeks. So saying a mild winter, the average is a normal winter. I would say maybe a little bit more than the average due to global warming. I mean, also Davos has seen more snow, so there is some snow, but not that deep. So the world is becoming warmer, also Germany, of course. No, the difference that was made is that we were able to fill the storages and build up new infrastructure. The LNG terminals, we have now 3 in operation, and the third one is coming in next weekend in Brunsbüttel, a small German harbor near Hamburg. And this was done in 10 months' time. And this is the astonishing thing. So that we have, the crisis is not over, but we can handle the crisis. And in last summer, we really looked in the abyss.
Yes.
The threat of an economic meltdown of European economy was real.
So you think we can avoid a recession?
This is banned for the moment.
But can we avoid a recession, given the strength that we've had so far?
Well, recession technically means that you have periods with negative growth. And it could be that we just slip away from that, but this is not good enough, of course. That would always mean that we have stagflation, that we don't have a period of growth. And my experience, my idea of the next year is that we will face in the first quarter of the year a phase of the world economy where there's no growth, but in the end of the year, I think China will bounce back, and we will get to a new period of then hopefully sustainable and green growth.
Minister, do you think that Germany has overpaid for gas? So we've seen gas prices up. You've paid more than they are now to stockpile. Was that the right decision still?
Well, yeah, it was the right decision, and yes, it was. We paid for high prices. In August, we tried to fill the storages, and therefore, of course, the 350 euros the megawatt hour we paid, then they were not sustainable. We destroyed the market in a way. This is true, but due to that, now the storages are full. Imagine the vice versa situation, that we haven't done that. The prices in August would remain lower, but now the storages would be half empty. Then you would ask me, are you crazy? Why aren't the storages full? So I think, yes, it was a hard decision, and the prices were absolutely too high, but the result is that we now have low prices.
Does it mean though that contracts...
prices, they are not low actually, but they are now above, short above the price niveau before the war.
Would contracts going forward have to have clauses, I guess, to see whether it goes down, or is this the only way you win the war on gas against Putin?
Sorry, I haven't got it.
Do former, I know they're very heads of state arriving. Is there, when you look at the contracts in the future for gas prices and how much you buy to stockpile, does it have to involve a clause where if they go down, you pay less?
Well, actually, we see that the markets are reacting, and and these are the most effective instruments. The markets bring the prices down as long as the markets are functioning. We had the period in last August where the markets were not properly functioning because we gave the sign we buy everything to every price. This was, as I've explained before, not healthy, but necessary in a way. And we should avoid this kind of period again. But if this would happen, then we should interfere in the markets.
Minister, do you believe that, Vladimir Putin lost the war on gas? He was using a lot of the commodities as a war against the West.
With Europe, he has lost it. Yes, he made it. He made the wrong calculation. We are able to manage without Russian gas and oil and coal. For the world, of course, other countries are buying oil and gas from Russia, which is not helpful right now.
Minister, the other question, of course, is Europe really being up in arms about the Inflation Reduction Act in the U.S. How does this end? Is there going to be an agreement?
Up in arms is maybe a little bit too strong, because first I would like to say I really appreciate that the US economy is moving into a green economy, that the government took the right decision saying global warming needs climate action, and now we are bringing all our financial force into climate neutral industries. But there were parts of the inflation, or there are parts of the Inflation Reduction Act that are problematic, that are not in line with WTO, that if Europe would answer with the same attitude, no, they should not. We learned in the last year, especially in the last year, that the transatlantic partnership is strong, that we are partners, and we should not be engaged in a trade war. Yeah. But things are moving slowly, too slowly actually, but they are moving in the right direction. So there are changes in the interpretation of the IRA, and Europe also has to do its homework, and if both countries or both continents are doing their homework, then we will succeed.
Minister, thank you so much for joining us today. That was Minister Habeck, German Vice Chancellor and Economic Affairs and Climate Action Minister Robert Habeck. Coming up, we'll have plenty more, of course, from Bloomberg, and don't miss our exclusive interview. Our editor-in-chief will speak also to the German Chancellor Olaf Scholz. More Bloomberg Surveillance Early Edition your way from Davos. This is Bloomberg.
I think we were all a bit surprised as to the speed at which China opened up energy need, commodity need in China. I do think it's a very good signal. It will be supportive of a momentum, but the true inflection point we have not kind of seen yet.
I think that the medium-term potential for China's growth is still something where we do see it coming down.
Actually, we think that the Chinese economy is going to massively outpace the rest of the world as we go into the second half of 2023 and into 2024.
This is Bloomberg Surveillance, Early Edition with Anna Edwards, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong. Our top stories today. China's economy is proving more resilient than analysts expected in the face of the COVID outbreak. That's adding to the bullish case for commodities. It's a rare case of an activist targeting a prominent Chinese company. Meme stock investor Ryan Cohen takes a stake in Alibaba and wants the e-commerce giant to buy back more of its own shares. And Goldman Sachs and Morgan Stanley are out with fourth quarter earnings today. We'll see if they join their peers with a big drop in M&A fees. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. And Kailey, welcome back to the American market, of course. Europe was up and trading, going nowhere busily yesterday. European equity markets losing their poise this morning in the face of a little bit of selling on US futures.
Yeah, and you didn't see much of a firm footing for stocks in Asia overnight either, Anna. It really was a wishy-washy day with not a lot of movement overall at the headline level for the MSCI Asia Pacific Index, which was very, very little changed. We're talking less than 1/10%, essentially flat on the day. You had gains in Japan offset by weakness in Hong Kong, and Chinese stocks were a little bit lower as well. Interesting, after we got Chinese GDP data out for the year 2022, 3% growth for the Chinese economy. That is the second slowest on records going back to the 1970s, but we did see better than expectations data for the fourth quarter and December specifically. So shows a little bit more resilience for the economy, even in the face of the virus outbreak that really was spurred by the releasing of COVID-0 policy. So that could set the stage for a recovery in the economy. Interesting, though, to see the Chinese yuan weakening against the dollar by about 0.6% to 678, and also weaker on the day, the Japanese yen, the dollar strengthening against the yen by about 0.2% to 128.78. But of course, in Japan, really, Matt, the focus is on the bond market as that 10-year JGB yield remains above that 50 basis point cap set by the BOJ. Right now, trading just over 52 basis points. Traders really betting we are going to see even more adjustment to yield curve control come that decision tomorrow, Matt.
Yeah, that is fascinating. Can't wait to see what the BOJ has to say. Here in the U.S., we have futures down about 0.33% this morning. We were higher on Friday in the cash trade, of course, no trading yesterday, but we've gotten back up to about 4,000. I think we closed at 39.99 on Friday, so we're up about 12% from the lows that we saw in October. Today, though, there are renewed concerns about growth out of China, and we have yields on government bonds really competing against stock yields. So 350, we're up another 5 basis points today as investors sell off the 10-year. We also see crude coming down a little bit, but at 79.59, we're right up against that $80 level. I actually had a dream about Jeff Curry. It was weird, but pitching investors that he's bullish commodities because the U.S. or central banks are maybe done raising rates or getting there, because Chinese growth is coming back. Hopefully, it'll spur demand this year, and because if European economies grow faster than expected, those are all good things for commodities. Bitcoin at 21,167. We're back up to the high that we saw before the collapse of FTX. So before that November weekend that saw everything go down in flames and the price dropped to 16,000. Now we're back up to 21,000 and change, and it's a real shift in terms of crypto sentiment. Of course, don't miss our program today at 1 p.m. New York time. Kailey and I will lead Bloomberg Crypto.
Matt, I really wish my dreams were as constructive and as helpful to my day job. But anyway, this is what we see on European equity markets. European stocks making some modest losses today after modest gains yesterday, whilst Martin Luther King Day was taking place, of course, in the US. No trading there. So we've got European equity markets dropping back what they gained yesterday, pretty much. We've had some data just breaking, which underscores the change in sentiment we've seen for European assets, certainly from the start of this year. Germany, January ZEW investor expectations. So this is a survey of investors in Germany and what they expect to see in the future, and they have risen to 16.9, those expectations. The estimate was for -15, so we don't worry about what the numbers mean in themselves, but certainly that number much higher than had been estimated. It's positive, not negative, and so just a reflection of some of the turnaround in the German data that we've seen of late. And European expectations have been on a turn, and that's something I'll pick up in a moment. Let's go into the UK first. The UK two-year yield, rising yields here in the UK. We see this across a number of geographies, certainly here in Europe today, but the UK story getting a little bit more of that. We had wage data out today that showed historically very strong levels of wage growth, up by 6.4%. Another headache for the Bank of England. A lot of talk about whether we see another 50 from the BOE, despite the Fed dropping down to 25. Euro dollar at 108.14, pretty flat actually, but we heard from Philip Lane. He's talking about the need to get rates to restrictive territory. We heard from Mario Centino at the ECB. He was the one talking about how he's quite surprised also about the strength of the European economy. And here's one of the reasons we've seen that strength, of course, that big drop down that we've seen after that big spike up in gas prices here in Europe, down to the 54 euros a megawatt hour level. This is a drop of only 1.6% today, but I put it in here because yesterday European benchmark gas prices dropped by 14%, so a big drop yesterday, and we continue to build on that today. Credit Suisse down by just 1%. We heard from the chairman earlier on the slopes of Davos, Matt. He was talking to the team there, and he was talking about how the outflow story is stopping. They're starting to see some inflows, and some bits of the business really doing well in his view.
All right, we'll keep an eye on Credit Suisse and the banks for sure today. Let's get back to the Chinese economy, though, because new GDP data shows it grew at the second slowest pace since the 1970s last year. However, the 3% GDP rise was better than most economists had anticipated. James Mager, Bloomberg economics editor for Greater China, joins us now from Beijing. So, James, China's economic growth surprisingly strong in the final months of the year. What were the drivers of that?
It was a surprisingly strong December. we were expecting a 9% slump in retail sales in September, when it barely fell. It fell 1.8%. Industrial output was again much stronger than expected in the data, and that was surprising because December was seen as being a write-off for the economy. Basically, China, the first week of that month was COVID zero, and lots of cities were sort of in a half lockdown state. And then suddenly, on the 7th of December, the government reopened the whole country, and then everyone got COVID. So, it was seen as being the data would be very weak. That doesn't seem to have been the case, at least according to the data that was released today, and that's really boosted the overall performance for the year. You had stronger industrial output than we expected. We had stronger retail sales, stronger investment data, and that seems to have put the economy in a better position for last year, and also is increasing confidence that the rebound this year will be stronger and faster than people had expected.
Okay, James, so while we're talking about the economy growing, we're also talking about the Chinese population shrinking for the first time since the Great Famine in 1961, which is a pretty historic change for the largest country in the world. What does this mean?
This is not a temporary change. This is a permanent change in China's population. You're seeing birth rates come down. Births have fallen now for 6 consecutive years. They were below 10 million last year, and deaths are rising. Obviously, as the nation gets older, those are only going to increase, and we should probably see a spike in deaths this year because, as I just said, the coronavirus is now spreading across the whole country. Most of the deaths that are going to come from that are going to come in 2023. So 2023 is probably going to see fewer births and more deaths again. And even leaving aside the COVID and those kind of temporary measures, once countries go onto this path of falling births and an aging population, it's almost impossible to reverse that. If you look at the case of Japan, South Korea, Taiwan, even countries in Europe as well, once that happens, there's nothing really the government can do, whether it's subsidies, free school, parental leave, that really reverses that in a substantial way. And that's going to change, Chinese demand for commodities. That will change how many Chinese children want to go and study in the UK or want to go and study in the US. So demand for university places overseas. It's going to change, and lots of things about the domestic economy as well. It's a really historic shift that we see today.
Yeah, absolutely. A story that could reach far and wide. James, thank you very much. James Mager, Bloomberg Economics Editor for Greater China, reporting there from Beijing. Now, global markets got a sugar rush when China reverted to pro-growth policies in late 2022. And some are arguing it's not too late to join the rally. OPEC Secretary General joining the growing chorus of voices bullish on China.
We've been always very bullish on China. China is a big economic powerhouse, has significant implications for global oil demand. We saw what happened when China closed down. Now everybody is optimistic about China opening up. So I say yes, we are optimistic, but again, we are cautiously optimistic.
Bloomberg's Danny Berger joins us now for more. Of course, in the short term, Danny, going from COVID zero to COVID everywhere has been a negative, but medium term or even slightly shorter time horizon, there are a lot of voices turning really bullish here.
And I think that's part of the reason why analysts think that not only does this rally have further to run, but a lot further to run. There has been that caution around China trading to some degree. That means that equities, the renminbi, all of them can get stronger from here. That's not fully priced in. So, for example, you have cities saying that they think the MSCI China could rally another 20% into the year end. Morgan Stanley, Goldman, they only see about 10%, but still that is higher after already rallying about 40% since the start of November and when we started to get those restrictions easing. And a lot of that has to do with domestic consumption and a services-led recovery. So that stands to reason for things like the onshore yuan. UBS sees that strengthening to 6.5 versus the dollar. And the global implication is one of commodities. A lot of calls, ING thinks oil is going to go above $100 per barrel. Goldman thinks that we will see copper go above $10,000. The things that Matt's dreams are made of, apparently Jeff Curry really feeding that into his thesis that we have a bullish concoction for the commodities market as a whole. China demand will come back and that supply will remain really tight, Kailey.
Yeah, I have to say most of my dreams are work-related, like I show up late to the show or something, but I can't say I've ever dreamed about specific calls. So this is a new one for all of us. Bloomberg's Danny Berger, thank you so much. Now, another story we were watching this morning, revered meme stock investor Ryan Cohen is pushing Alibaba to speed up its share buyback plan after acquiring a minority stake in the Chinese tech giant. For more, we're joined by Bloomberg Quick Takes' Alex Webb. So, Alex, A, what's the advantage of buying into Alibaba now? And B, how likely is it that he is going to be able to affect much change at all?
So it's been a punishing few years for the tech giants in China. There was a huge crackdown from the government. They felt that these companies were overextending their reach and their influence. The stocks, therefore, came down considerably. What we saw in December with the loosening of COVID-0 was a sort of realization from the powers that be that to reinvigorate growth, they needed these tech companies. So there was some comments in the planning meeting in December that suggested they're going to support the tech industry a little bit more. If you look at then buying in, the stock has been trading near historic lows, well below the IPO price as a multiple of forward earnings. It's therefore quite opportune to buy in there with the possibility that it's going to recover. The question is whether he's actually going to be able to affect change. That might be a little bit trickier. His stake, while it might be in the hundreds of millions, is very, very small as a total percentage of Alibaba. Now, nonetheless, Alibaba has in the order of $80 billion in net cash. So maybe he's pushing at an open door here, and it's something that the company is willing to do anyway.
OK, Alex, good morning. In other tech news, Microsoft says it's going to add ChatGPT to its cloud-based Azure service. That's coming soon. What does that really mean in real terms?
So there are a number of different applications for this. You could just be, if you're working on Microsoft's cloud platform, you could just have this as an assistant. You know, you're designing code which you're going to ingest into GitHub, another platform that's owned by Microsoft. That can be augmented by ChatGPT. There are other businesses which perhaps we don't know if it's going to be able to. They'll have products where you can use it live on the fly for customer applications. Microsoft, for instance, has chatbots, right? So if you are trying to talk to your telecoms provider, often online, you will have a chatbot that interacts with you to begin with. On the whole, they're not very good. Microsoft provides some of that technology that could potentially be augmented by ChatGPT.
Yeah, they're definitely not very good, but it would be sweet if they were better. All right, Alex, thanks very much. Bloomberg Quick Takes. Alex Webb talking to us about all the tech stories in markets this morning. Now, big bank earnings are going to continue to roll out. Goldman Sachs and Morgan Stanley set to report before the bell. Bloomberg's Charlie Wells joins us now with what to expect from the finance industry. Charlie, what do we got?
Well, Matt, this is maybe less of a dream and more of a nightmare scenario. So analysts and investors are trying to figure out just how bad the wipeout in investment banking revenue is going to be at Goldman and Morgan Stanley. Analysts are expecting it to be down between 50 and 60%. That would put it in line with its peers. JP Morgan posted a miss, revenue down 60% in investment banking. Similar story at Citigroup. Now, when you focus in on Goldman, there are a lot of questions from investors about what its medium-term strategic direction is. This was a difficult year for Goldman. They had a major restructuring, one of the largest in its history. They're also currently in the midst of an incredibly large round of layoffs, again, one of the largest in its history. So a lot of investors are asking, where are we going from here? When you look at Morgan Stanley, there are also headwinds that a lot of these other pure play investment banks have faced. So it will be a question of how bad the damage is there. On the upside, there is the potential from fixed income trading. We'll have to see how well that desk performs. There also could be some upside from wealth management.
OK, a lot to watch out for then, Charlie. Thank you very much, Charlie Wells, with a preview of Goldman Sachs and Morgan Stanley to report later today. Coming up, we are live, of course, at the World Economic Forum this week. We will be speaking today with Ken Rogoff, Harvard professor and former chief economist at the IMF. Stay tuned this hour for that conversation. Plus, we'll bring you more from our interview with the UBS CEO, Ralph Hamers. He shared his view earlier from the Swiss Alps.
We are expecting that every month we will see a further decrease. I think that inflation at higher rates than what we're used to is here to stay.
Welcome back to Bloomberg Surveillance. This is the early edition. We are simulcast on both Bloomberg Radio and on Bloomberg Television. I have a chart showing the Bank of Japan's bond buying sorted by days over the past few years. And for those of you listening on radio, I'll just tell you, they spend a lot of money to uphold yield curve control. In fact, over the last 4 days, Valerie Teitel tells me they've spent over $100 billion. This chart's in yen, but it goes up to $5 trillion on just one day. Joining us now is Bloomberg Markets reporter Justina Lee to tell us, just how much longer, Justina, the Bank of Japan can continue. I mean, they almost have all the bonds anyway, considering how much buying they've been doing.
Yeah, that's right. And they've really opened the Pandora's box there, when they tweaked the policy recently. Now, almost all Bloomberg economists, that was surveyed are expecting no change tomorrow. But I think a lot of people are now talking about a change eventually. And that's for a couple of reasons. I mean, one is that we have seen inflation start to pick up in Japan as well. And another is that, as we have seen in the chart that you put up, I mean, the Bank of Japan really has become this majority owner of, Japanese government bonds. And that really is starting to impact market functioning to the extent where liquidity has gotten a lot worse in these bonds.
Okay, a really interesting piece by our colleague Garfield Reynolds talking about, to Matt's point, if they kept buying at this pace, they've only got, I think, 33 weeks until they've bought up the whole market. They'd be running out of JGBs to buy. Taking the conversation closer to where we are then, Justina, let me ask you about Europe. We've had some comments from Philip Lane, used to be talked of as a dove. I don't know if there are many doves around these days, but the ECB rates must go into restrictive territory, he tells the media. What do you make of those comments?
Yeah, I mean, we have seen a bit of market reaction today with yields going up and stocks coming down. And I think what's interesting is that it kind of echoes what we're also debating, over there in the U.S., which is whether central banks can start slowing down those rate hikes now that we have seen inflation coming down. And this has been especially true in Europe, where inflation has been surprising to the downside. I mean, partly because it's been warm over here, and so kind of gas prices haven't spiked as much. But I think what kind of he's pointing out is that, it's not just about, the energy prices. It's not just about a short-term slowing of inflation. They really kind of want to make sure that expectations for inflation are not getting anchored and to make sure that they're tackling the problem and not just kind of, going back to easing mode, as some people in the market seem to be expecting.
And it is interesting to keep hearing from these ECB officials as the data continues to improve around Europe, and we certainly talked about that at the end of last week in the German context. Thanks to Justina for thoughts on that. Bloomberg's Justina Lee. And for more market analysis, check out MLIV Go on your Bloomberg terminal. That's where you'll find the Markets Live blog. They'll be across all about the Bank of Japan and, of course, everything that's moving markets. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Matt Miller in New York and Anna Edwards in London. Now keeping you up to date with news from around the world, here's the first word. The British government has escalated its feud with pro-independence forces in Scotland. Prime Minister Rishi Sunak vetoed a contentious new law on gender recognition that was passed by the Scottish Parliament. Sunak's veto came as the administration in Edinburgh pushes for a referendum on full autonomy that London is refusing to permit. In Venezuela, public sector workers mounted the biggest anti-government protest in years. Workers organized at least 50 protests on Monday. In Caracas, teachers were joined by nurses, pensioners, and others demanding more money from the government. They've been falling behind in an economy that has embraced the U.S. dollar. A new report says that international trade will grow more slowly than the global economy over most of the next decade. According to the Boston Consulting Group, the war in Ukraine will reshape strategic alliances and alter the flow of cross-border commerce. The report forecasts that trade will grow at an average 2.3% through 2031. And Nissan and Renault reportedly are nearing an agreement to revamp their alliance. According to Japan's Yomiuri, the deal could be reached this month. The report says Renault will lower its stake in Nissan from 43% to 15%. Meanwhile, Nissan will invest in Renault's new electric vehicle business. Coming up, we will turn our eyes from the auto sector back to the global economy and head to Davos. Lisa Abramowitz will be speaking with Ken Rogoff, Harvard professor and former chief economist at the IMF. This is Bloomberg.
This is Bloomberg Surveillance, the early edition. Here's what you need to know. China's economy is proving more resilient than analysts expected in the face of the COVID outbreak. That's adding to the bullish case for commodities. It's a rare case of an activist targeting a prominent Chinese company. Meme stock investor Ryan Cohen takes a stake in Alibaba and wants the e-commerce giant to buy back more of its own shares. And Goldman Sachs and Morgan Stanley are out with fourth quarter earnings today. We will see if they join their peers with a big drop in M&A fees, of course. I'm Anna Edwards in London, and Matt Miller and Kailey Leinz are with me in New York. Of course, M&A fears, of course, a feature of this reporting season over in the United States, as they haven't been so easy to come by. That's going to be a big focus, Matt, later on today, isn't it? The reporting season from the US, of course, also dealing with some interesting data out of China overnight.
Yeah, absolutely. And the data out of China, interesting because although it was pretty bad relative to history, it was pretty good relative to expectations. So you're not really seeing that shine through in markets. We still have futures down here, and we have rates higher. So take a look at S&P futures off about 0.25%. We closed in the cash trade right under 4,000 at 39.99, and we're about 12% higher now than we were in the October low. So it's been a steady march up as, I guess, the pessimism has come out of this market, and a lot more people are hopeful for China. A lot more people are hopeful for Europe, also doing better than had been anticipated, as we heard from members of the ECB. So that's good news, but you're not seeing that play through in risk assets today. NYMEX crude coming off a little bit, just about 0.2%, but still holding at almost $80 a barrel. And then Brent, of course, is up a little bit over 85 right now. And then Bitcoin, right now, 21,111. It's coming down a bit, but from what we saw on Friday, from what we saw last month, really it's climbed remarkably back to the levels that it was before the collapse of FTX. So it's as if none of that ever happened for everyone who didn't lose, $8 billion in the exchange. Kailey, what do you see in terms of pre-market movers?
Well, for all the gains we've been seeing in Bitcoin as of late, Matt, they've been even greater for some of those crypto-related equities, and that is definitely continuing in the early session this morning. Coinbase looking for a sixth consecutive day of gains. That exchange is up about 6.3% before the bell. Already, it's up 40% so far in 2023, so it really goes to show you just how far some of these names have rallied, and that has been especially true for some of the mining stocks in particular, and that is on display once again today. Riot Platforms, of course, formerly Riot Blockchain, up 8.6%, Marathon Digital by more than 10%, Bit Digital by about 32%. And so all three of these examples, Anna, of the rally we have seen in some of these Bitcoin mining stocks, they actually could see their best month in over a year. They're already up 60% or so in the month of January.
So that expression of risk appetite could be to the fore then, Kailey, today. We're not seeing that in stocks here in Europe. The equity market session in Europe down by 0.25%, but it has been, to Matt's point, a really strong start to the year for global equities, a feature of the China reopening story and the European optimism. Two-year yields in the UK, those yields coming higher as we see that debt being sold off a little bit. The wage data coming in historically high levels, 6.4% in wage growth for the UK economy. Does that put more pressure on the Bank of England to do yet more hiking, even if the Fed is stepping down in the size of its hikes? And the euro, 108.12. Matt was talking about some of the comments from the ECB officials. Philip Lane talking about getting to restrictive territory. We talked about that with our colleague Justina Lee earlier. And natural gas prices down another 2.6% today in Europe on this European benchmark of gas prices. Kailey, yesterday that number dropped by 14% in session.
Well, of course, Anna, the energy crisis, climate change, the war in Ukraine, the broader global economy, all topics of conversation at the World Economic Forum in Davos this week. So let's go there now, where Bloomberg's Lisa Abramowitz is standing by with Ken Rogoff, Harvard professor and former chief economist at the IMF. Lisa.
Kailey, thank you so much. It's been an honor to be here and hear some of the conversations as people really try to dissect all the big issues that you're talking about. And our next guest, Kenneth Rogoff of Harvard University, formerly of the IMF, as well as the Federal Reserve, really diving into where we are in the interest rate cycle as it pertains to recession and some of these discussions. So I want to start with this idea that you've talked about, that it was not free. It wasn't a free lunch to have all this cheap debt that then would end up having some problems when rates rose. We haven't seen that. In fact, debt and credit has held in pretty well, and people are looking for this year to be a really good year for those debt instruments. Does that surprise you?
Well, it has surprised me that, we had interest rates go up so much and many pockets of weakness in the global economy, especially in emerging markets. Less has happened than I would have guessed. But at the same time, if you look at the history of debt cycles and interest rate cycles, it's never just one thing. So if just commodity prices are low or just interest rates are high, it's not enough. So if interest rates stay high because inflation stays high and we have a recession, which I still think is a distinct possibility, that's when you're going to start feeling pain.
At this point, though, it's actually been a benefit, ironically, to corporate debt, to government debt, because it has inflated away some of the debt. So it's actually created a boom. So how long could you see that continuing to provide a tailwind to a market that's massive and that has been inflated by these low rates to start with?
So absolutely, we've seen effectively of governments a partial default on debt. I mean, there's been unexpected inflation, probably of the order of cumulatively of 10% or more, and that's a de facto partial default. And so it makes it easier. The question is, and this is also true for corporates, when does that start getting built into rates? And also, I mentioned, I think the real interest rate will be higher. But if we don't have a recession, I think it will be a great year for credit, no doubt about it.
What about in emerging markets? Because a lot of people are going into certain developing areas, especially in light of the fact that we haven't seen the massive disruption that some people were expecting there either.
Yeah, but we are seeing inflation in emerging markets. So a lot of emerging market borrowing has actually been in their own currency, and they have had inflation. So it, although it hasn't had the drama necessarily of defaults, not necessarily the case. The returns are going to be fantastic. But sure, emerging markets do well when you don't have a recession, and we'll see.
You say that you do think that there's going to be some sort of downturn, that we're not out of the woods. What makes you say that?
Well, I mean, I think it's a few things, but fundamentally, when we're in an interest rate cycle like this, although markets react very quickly, the effect on the real economy from employment to growth, that is, say, 3 quarters to 6 quarters or even more. There's like many meta studies that sort of come to this conclusion. So that's the trickiest thing about Fed policy and central bank policy is you're driving a car and you have to push on the brakes, a mile before you actually want to stop, and you don't quite know what you're doing. And so there's a lot of uncertainty around it. I think they're going to keep raising rates a little more because inflation's still high. And I think we're seeing signs of weakness. Of course, if we have peace in the Ukraine or something like that, which would be amazing, that would be an incredible shot in the arm. If we have something go worse there, that'll be really bad.
Well, when you talk about how it takes 3 to 6 quarters to really work its way through the system, what about one of the main industries, both in the U.S. and globally, in real estate? How far into that cycle are we, considering that a lot of people viewed it as the first hit in some ways because of how high mortgage rates got?
So equities and housing move in sync with interest rates, but equities move much faster. Housing famously, prices, especially down, move much more slowly. People just sit on their house. They don't want to sell their house. So if, as I think, interest rates are going to stay high for some time to come, I think there's still a lot of downward adjustment in the housing markets globally, not just in the United States.
What kind of range are you talking about?
Well, I mean, certainly another 10%, I would think, over a couple years still. Housing isn't quite as volatile as equity when you look at the beginning and the end of these cycles, if you look at 2008, for example. But, that'd be off the top of my head, the number I picked.
You said that you expect rates to remain higher for a longer period of time. What kind of level are you looking at, and for how long is a long time?
So there are two components to rates. How long is inflation going to stay high, and how much is the real interest rate going to adjust? And also recessions, I should say, is mixed in there. So if you look at what happened after 2008, inflation fell, but interest rates fell much more. Like on average, forward-looking real interest rates were falling 200 basis points over that period, peak to trough even more. So what I see longer runs, we're looking past whatever recession might happen, inflation will eventually come down, maybe just to 2.5%, not to 2%, but interest rates are not going to come down to the same level as they were before. They're not going to come down to the same level as we saw. I wouldn't be surprised to have, say, a Fed funds rate of 3.5 quite a while from now. And, a 10-year rate of 4, for example, even three years out.
Wow. When you talk about, just to revert back, the consequences of that with housing, you talk about the global housing market possibly seeing another 10% decline, at least in the next couple of years. How does China factor into that? I know it's an idiosyncratic story, but you've done a lot of work on that, and we've seen some of that pain come through with developer bankruptcies and other types of losses.
So I think China won't have a Western-style financial crisis, but I think there's no question they reached a point where they're overbuilt. Housing, commercial real estate, infrastructure, and of course those of your viewers who've gone to Beijing and Shenzhen and Guangzhou, Shanghai, what are you talking about? Like, it just seems thriving. Well, go out to the equivalent of the Cincinnatis of China, which are 10 times bigger in population. They also have amazing office buildings and housing. In fact, I think something like 88% of the roads are out there, a lot of bridges, infrastructure. And just as the Soviet Union came to the end of the line with its steel and cement plants, Japan with its bridges to nowhere, I think China's reached that point, and it's got a big adjustment to make. I think that's something among the many challenges China faces that's not something they can just turn a dial. They've got rid of the 3 red lines to try to improve the short term, but it's overbuilt. And I don't think, and especially in these tier 3 cities where the jobs didn't come, that's the Cincinnatis, where the jobs didn't come, where people are starting to leave, where prices are falling. And there's not a quick fix to that.
20 seconds. What's the question we're going to be asking about crypto? Because you don't think that it's necessarily dead in 2 years from now.
Well, it's going to need to be regulated a lot. I favor, strong regulation, but that's can't be done by one country. If it's still legal in Russia, you can still own it here and potentially spend it. Maybe Russia wasn't the best example, but it's going to probably remain legal in a number of countries where the government doesn't completely control the country. So that's going to give it value.
All right, Ken Rogoff, thank you so much for being with us here in Davos. Back to you, Anna.
Lisa, thank you very much. Lisa Abramovitz with Ken Rogoff in Davos, ending that conversation on the possibility of regulatory arbitrage within the crypto space. One for the crypto show later on today and in other episodes, perhaps. We'll have much more from Davos throughout the day, including Lisa's interview with the Chevron CEO. Mike Wirth joins the Bloomberg team. That's at 8:30 a.m. in New York, 1:30 p.m. in London. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the Principal Room. Coming up later today, an interview with German Chancellor Olaf Scholz. That's at 10:30 a.m. in New York, 3:30 p.m. in London. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Matt Miller in New York and Anna Edwards in London. Well, it's another big day for the big banks. They'll remain in focus as Goldman Sachs and Morgan Stanley are set to report their earnings before the opening bell in just a few hours' time here in New York. Sonali Basak, our global finance correspondent, is joining us now for a preview. So, Sonali, what's the read-through going to be from the JP Morgan and Citigroups of last week to Goldman and Morgan Stanley today?
Well, what you saw on Friday was a lot of the market shaking off concerns about the consumer despite provisions rising. Now, if you turn back to today, we're focused on core institutional businesses. We're focused on trading. We're focused on investment banking. And when you look at the bar that's already set by Wall Street right now, based on the estimates, the bar is pretty low. There's a lot of room here for beating in fixed income, particularly for Goldman Sachs. So you want to see them come in higher than expectations there to please the market. But when you come to Morgan Stanley, they're bigger in equities trading. So it's the competitive dynamic there I would watch. All through last year, you saw them neck and neck, and you saw a couple quarters there where Goldman came in above Morgan Stanley in a business that Morgan Stanley has traditionally been bigger at in equities trading.
All right, so we'll be focused very much on the trading numbers as usual. You mentioned investment banking as well. What about M&A? What about IPOs? What about bond issuance? Is this year going to be good for that, or are we looking for bad news on that front?
So, of course, there's expected to be a drop-off. I would watch Morgan Stanley's numbers pretty carefully because if you look at the league tables, Goldman's lead was very significant when you look at JP Morgan and Morgan Stanley. Goldman is expected to still, in a bad year, bring in more than $1 billion in the quarter for advisory revenues. Now, if you look at this year, JP Morgan has already said that the pipeline has been building, but it depends on how the year goes, really. We'll want to see if Morgan Stanley in particular brings up leverage finance, given that Twitter deal overhang that has existed. We saw JP Morgan kind of shake off some of those leverage finance concerns and say they're in the market, they're open for business. And Jamie Dimon himself said he's not overly concerned about that business right now.
Sonali, staffing levels and the future of the workforce springs to mind when you think about these types of businesses, in particular Goldman Sachs.
Yeah, in particular Goldman Sachs. If you take a look at it, Anna, let me put this in context to you by the numbers for a second here, because Goldman Sachs is expected to bring in an efficiency ratio of less than 69%. By comparison, for Morgan Stanley, that's 75% or higher. But if you look at returns on equity, Morgan Stanley is still supposed to post a higher results in that regard. So really, this is a matter of profitability. You have to keep a clamp down on costs here in some way. You're seeing that happen in terms of larger headcounts over at Goldman Sachs. I think Morgan Stanley is going to have to answer if the conditions change in the environment here, whether they're going to have to make steeper cuts than they already have. For Goldman, remember, we've been talking about it, the number, while it is large, it still only brings you back to about a year ago in terms of a headcount. So Goldman's strategic realignment here and how much of those cuts come from investment banking and trading and what that means for their competitive dynamic is important, especially as we watch them break out for the first time their new segments here in which they are reporting differently, especially for that consumer business where everyone is going to be watching very closely in how they pivot that business into the investor day that's at the end of February.
Well, to that point, Sonali, we learned Friday that Platform Solutions business lost $1.2 billion in the first 9 months of 2022. I would imagine there's going to be some questions about that on the call. Where else do you think analysts are going to be focusing? What are they going to be looking for when they hear from these executives today?
I think two things. On Goldman, of course, it's at $1.2 billion. That's actually supposed to be $2 billion about for the full year. So it's a significant number. That's about $4 billion over the last couple of years. Some of that is provisions, but some of that is straight expenses. So what can be cut? I think also how you invest into the environment still. Costs have been the story of the year. Costs will continue to be the story when you look into this year. The other thing I would say is if you're scaling back some of these consumer ambitions, you have to watch asset and wealth more closely, especially in this choppy environment. Goldman is doubling down on this business. Well, guess what? So is Morgan Stanley. So is JP Morgan. So even there, the competition is pretty stark. I think one bellwether sign for the industry that is kind of good news here is that BlackRock number kind of coming back up when it comes to the passive numbers. So when you look at what Morgan Stanley is doing and kind of shifting to some of that passive, there will be questions about what kind of share they can gain, how much net interest income will be a boon for them because they lend to the wealthier segments here.
Right.
And similarly for Goldman Sachs, whether they can kind of compete on that scale.
Sonali, thanks very much. Bloomberg's Sonali Basak on all the ways that these businesses are competing with each other and some of the themes to watch as we hear from Goldman Sachs and Morgan Stanley. Coming up, The View from Davos. We'll bring you part of our interview with the UBS CEO, Ralph Hamers, who tells a very different story when it comes to hiring compared to Goldman Sachs. More on that next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kailey Leinz here in New York. Anna Edwards with us out of London. Now, UBS CEO Ralph Hamers believes inflation will stay higher for longer. He spoke to Bloomberg's Manus Craney earlier in Davos.
Just go back last year, the war, the sanctions, the energy crisis, supply chain still faltering. I do think that the opening up of China, the impulse it gives to consumption in China, energy need, commodity need in China as well, I do think it's a very good signal. It will be supportive of a momentum, but the true inflection point we have not kind of seen yet.
The natural corollary to that is you as a house were way ahead on your call on China. You've reaffirmed it this morning. Is That movement from China, has that been reflected by the clients? Are they much more active in taking China risk?
Well, we've seen more activities, but we have certainly advised them to go long on China and to be overweight on China. That's what we came out with on time, I guess. I think we were all a bit surprised as to the speed at which China opened up, but I think. Advising the clients, and they really have come, and you know that from the third quarter. Clients in periods like this need more and more advice. They really come to me, I'm talking to them, and they're saying, well, okay, help me reading these data, help me reading these trends, where should we go? And basically they put a lot of money with us to manage for them, right, in the third quarter.
And are you saying cash first, reflect and wait for a pivot? Are you saying actively deploy, but judiciously? Which is the narrative for you?
We're still cautious as to the balance that you bring, and but there is moments to invest. There is absolutely moments to invest.
The other big debate is this: peak inflation, peak rates, and peak liquidity. Now, there's two bids there, and there's one offer. If I look at the inflation narrative, the consensus is building peak inflation, and it will drop precipitously. Are you expecting a precipitous drop in inflation?
We are expecting that every month we will see a further decrease. I think that inflation at higher rates than what we're used to is here to stay. And there's a reason for that. If we truly look at what has happened to us in the world over the last 3 years, we do think that we're going into the era of security. It's energy security, it is about food security, it's about technology security. For that, part of the supply chains that we are still dependent on will have to be rolled back, which basically means you bring labor back, you have to invest. The energy transition is still at its infancy, at its start. Lots of investments will have to go into becoming less dependent on energy from other countries. So I do think that inflation will be higher than what we are used to in the past. So it will not come down to the 2% that we are used to. So we'll have to work with that, but it will decrease from here.
UBS CEO in Davos. We're in Davos. We're also in Berlin. Coming up later today, an exclusive interview between our editor-in-chief, John Micklethwaite, and the German Chancellor, Olaf Scholz, live from Germany. This is Bloomberg.